Welcome! Today, we'll thoroughly explore essential financial concepts about bonds and interest rates, structured clearly to ensure easy understanding. Here are the topics we'll cover. 1. Bond definitions and characteristics. A bond is like a loan you provide to a corporation or government. The borrower promises to repay the loan amount, known as the principal or face value, at a specific date called maturity. Bonds also pay regular interest payments known as coupons throughout their lifetime. Investors buy bonds at a specific price today to receive these future payments. 2. Differences between bonds and stocks. Bonds and stocks are two main types of investments, but they differ significantly. Bonds provide fixed income through predictable coupon payments and repayment of the principal at maturity. Stocks, however, represent partial ownership in a company, providing returns through dividends and potential increases in stock price, both of which are uncertain and vary based on the company's performance. 3. Detailed bond pricing formula. The price of a bond today, P0, is determined using a discounting formula. P0 equals coupon payment divided by 1 plus interest rate to the power of 1, plus coupon payment divided by 1 plus interest rate to the power of 2, plus coupon payment plus face value, divided by 1 plus interest rate to the power of n. This shows how future payments, coupons, and principal are discounted to today's value using interest rates. Fourth importance of interest rates in economic activity. Interest rates are critical as they determine the cost of borrowing money. Low interest rates encourage borrowing and spending, stimulating economic growth. High interest rates can slow down the economy by making loans more expensive and encouraging saving. Interest rates impact decisions on investments, buying homes, business expansion, and government debt management, significantly influencing economic health. ஐந்தாம் நிலை வாய்ப்பு எதிர்ப்பு. Real interest rates and their calculations. Interest rates are classified as either nominal or real. Nominal interest rates are those quoted by banks or lenders without accounting for inflation. Real interest rates adjust nominal rates for inflation, giving the true cost of borrowing and actual returns on savings. The calculation is real interest rate approximately equals nominal interest rate minus inflation rate. For example, if your bank offers 6% interest, nominal, and inflation is 4%, your real return is about 2%. 6. Loanable funds. Theory and determinants of interest rates. Interest rates are primarily determined by the loanable funds theory, which examines how supply and demand for money interact. Demand for funds, borrowers seeking money for investment and consumption. Supply of funds, savers offering money by saving rather than spending. Interest rates rise when demand exceeds supply and fall when supply exceeds demand. Other determinants include the risk associated with loans and the maturity period. The longer the term, generally, the higher the rate. 7. Dynamics of bond supply and demand, equilibrium, and market shifts. Bond market prices depend on supply and demand. Demand for bonds increases when investors become wealthier, expect low inflation, perceive lower risk, or find bonds more liquid. Supply of bonds grows with increased investment opportunities, higher inflation expectations, or when governments need more funds. Equilibrium prices and interest rates occur where bond supply and demand curves intersect. If expected inflation rises, demand for bonds decreases, prices fall, and bond supply increases, pushing interest rates upward. 8. Special concepts, Fisher effect and negative interest rates. Two special financial concepts are Fisher effect. Expected inflation directly impacts interest rates. Higher expected inflation leads to higher nominal interest rates to protect investors from inflation risk. Negative interest rates. In unusual cases, central banks set nominal interest rates below zero. The aim is to stimulate economic activity by discouraging saving and encouraging borrowing and spending, as experienced in economies like Japan. Summary: understanding bonds and interest rates helps us grasp the critical workings of financial markets and the broader economy. Bonds offer predictable income, while interest rates significantly shape economic conditions and personal financial decisions. Thank you for joining. Please subscribe, leave your comments and questions below, and stay tuned for more educational financial content.